Good morning everyone, my name is Peter Scolari and welcome to our webinar, How to Double Your Bank Balance Without Improving Your Bottom Line. Thank you for joining us. We have people from all over Australia, which is fantastic, and today's webinar is about getting an understanding, or business owners getting an understanding of the relationship between profit and loss and cash flow. And how that can be actually improved using a wonderful process called budgeting. So we'll be going through a number of issues regarding that. In terms of, if you have any questions, just please use the GoToWebinar application. You'll see there's a little area there where you can type those questions in. And if we have a look at an agenda on what we're going to go through today, I suppose we'll look at an introduction and see what all the fuss is about having a a budget and a P&L and cash flow budget. We'll look at the differences between a P&L budget and a cash flow budget. It's very confusing for a number of people if it's never been actually explained to them before. We'll go through the differing ways to go through the budget process, so we'll give you some ideas there. And we'll then have a session on using budgets with strategic planning, how you can actually do that. It's important to understand the bank's view of budgeting and what they're looking for, and we'll also consider some other benefits of going through what we're going to recommend today. And this is all about improving that cash in your business. There will be some key performance indicators which we believe you should be looking at, and then we'll wrap it up. And again, if you have any questions along the way, please use the GoToWebinar app and type those in, and we'll endeavour to answer those as we go. If you're having any problems hearing, please let us know, or if something happens. So in terms of budgeting, what is all the fuss about? Well, many business owners don't believe in budgeting, and typically when we suggest this to business owners, they often push back saying, well look, there's not much point doing a budget. I've got a fair idea what's going on, and it's usually the same each year, and you can't predict the future or change things, so why would I actually go through that process? And on the surface, that's a fair summation. However, when this is actually related back to us, or back to me, I think most of the time they don't have an understanding of how a budget in terms of revenue and expenses actually affects the monthly and yearly bank movement. So it's not until we give them an understanding of this that they typically start to think of ways to not only improve their cash flow but also their overall business performance. So it's pretty much an education process and reasons why, and when we go through today I think you'll understand what I'm talking about. In reality, and we were guilty of this years ago, and it's only been the last 4 or 5 years, and this is not meant to be having a go at our profession, but I think unfortunately very few advisors actually explain at the end of the year when the clients are sitting opposite them and going through the figures, and there's a lovely bound set of financial statements and profit and loss, balance sheet, sometimes some beautiful little graphs. But my question would be, have the advisors actually explained where the cash is and how it ties into the overall profit and loss result? And more importantly, have they actually given some tips on how to improve the cash at bank? So this is what we're going to look at today. So what is a profit and loss budget versus a cash flow budget? Well, the term budget is often loosely thrown around, and the reality is that a profit and loss budget and a cash flow budget, they are two very different beasts, even though they're related to one another. The profit and loss budget itself refers to budgets for revenue and expense items only. It does not include the timing of when the revenue expenses will actually hit the bank account. It doesn't include GST, so if you look at your profit and loss statement that's given to you by your advisors, unless you are not registered for GST, it won't have GST in it. It does not include capital repayments for bank loans, so not the principal amounts, only the interest. It won't include things like repayment plans for other liabilities, and it could be the ATO, for example, if you're paying back the ATO for income tax or in some sort of repayment plan with them or GST. It won't show monies introduced, for example, loan proceeds from the bank or owners tipping, having to put money back into the business, and it won't show things like dividends or drawings. But a cash flow budget is something that is very different. It actually refers to the expected cash inflows and outflows only. So it will include the timing of when the revenue and expenses will actually hit the bank account. So you need to understand, I suppose, in order to do a cash flow budget, you need to understand how long it's typically taken you to get paid. And there's all sorts of calculations that can be done to have an idea on what this is happening. Also, how quickly you might be paying your suppliers. A cash flow budget will also look at GST collected and GST paid out. It will show capital repayments for bank loans, so it will show the principal amounts, and it will also show repayment plans, so things such as the ATO, monies introduced for loans put in, and stock movement. So it might well be that if you go out and buy $100,000 worth of stock, typically you might have that sold at the end of the year, at the end of the month, or at the end of the year. Your P&L will actually add back that stock that you haven't actually sold. It will be an asset, whereas cash flow will actually take into account that that stuff has actually been bought and paid for, where it has been paid for. So why do we need to consider both of these? Why is this so important? Well, I just want to show you an example of a little graph that we typically like to use to show our clients. And when they're sitting opposite us, they will say, well, look, what was the final result? How did we go? Can you give me a bit of an idea on what's happening? And they'll often say, look, I don't understand. We think we made a profit, but our cash flow actually went down. We've actually got less cash. So how has that actually happened in the last 12 months? So what we'll do is we'll say, well, look, in this particular example, you've made a profit of $50,000, but included in that $50,000 there was a book entry called depreciation of $25,000. So, really the business has generated the ability to have $75,000 worth of cash at this stage. You did take a dividend of $20,000, so that leaves $55,000. Your stock actually went up by $30,000. The difference between June last year and June this year, you've actually bought 30 grand worth more of stock. So that has actually impacted on your cash flow and has actually come out of the profit that you've generated. So now we're down to $25,000 at the moment. We would expect at this stage, before going through the rest, that your bank balance would have improved. Your debtors have gone up by $50,000. So that just means that you've actually owed more money. So that's another reason why that cash is not in there. So the difference between last year and this year is $25,000. $50,000. So you're now sitting at $25,000 negative effect on your cash flow. Your creditors did increase by $49,000. Your tax increased by tax payable by $2,000. So at the moment you should have $26,000 extra in your bank account compared to last year. But we've had a look at your loans and you've actually paid back $50,000 in principal. So therefore your bank balance has now gone down by $24,000 compared to last year. So once we've explained that, the client is then suppose, getting an understanding of, well, look, if I made the profit, I want that to get into the bank, don't I? And I go, well, yes, exactly right. We want to convert that into the bank as quickly as possible. So then they'll say things like, well, okay, well, how do we do that? Well, we'll say, well, look, you need to look at some of the key drivers, such as, you know, your debtors and your stock. So how quickly are you turning over your stock? Are you buying stock, you know, unusually too early, unless there are some, you know, benefits, and perhaps sometimes there might be some supplier discounts, but that's okay if you understand that. But can we do something else with our cash flow? And that'll be, you know, looking at your debtors to see if we can improve the collection rate, etc. So once we've gone through that, clients will, I suppose, have a better understanding of why they might not have any cash and what they can do to fix it. So let's have a look at an example and see what happens when we can change a couple of assumptions. So set up a sample company. And this is the sort of thing that we would do with a client, but obviously with their their figures in, and we would do what we call a budget with them. We'll have an opening bank account balance, and we might say, well, look, we're going to do a budget for the next 12 months. We'll load in what your actual opening balances are, which is fine. But then we're also going to do some numbers on, you know, how long it's taken for you to get paid, how quickly you're turning over your debtors, how quickly you're paying your suppliers, etc. And if you look at this particular example, when we do the budget for the next 12 months, and you'll see that it goes from July 13 to June 2014, and we arrow down, and you'll see that they've actually made a profit of $219,000, but after tax they've made a profit of $153,000. So, you know, if we had that $153,000, if I look at the opening balance, and we had 50 at the start of the year, and we'd typically like to see that 153 turn into about 203,000 at the end of the year. However, when we look at how quickly they're taking or receiving their money, and how quickly they're paying out their creditors, and how quickly they're turning over their stock, the model has worked out that there's actually going to be, in this particular example, $399,000 worth of net cash outflows after taking everything into account. So we started off with 50, 399's gone out, so it's actually predicting at the moment that there'll be an overdraft of $348,000, which obviously, unless they can actually fund that or have a bank that will actually let them do that, that's actually quite scary. So the client might say, well, how has that happened? We've had a very profitable year, we've done well, but we've said, well, look, the reason why it's picking up that you are going to run out of cash is because that when we look at, say, some of your products, and you'll see in this particular case they've predicted that, you know, allowing for seasonality, that the widgets, there'll be 25 units sold in July and August at an average, you know, price net of GST of 5,400. That'll generate 136. The tax invoice there with GST on it will actually be 150. But we did some numbers, and they're actually only turning the revenue or getting their money in about every 52 days. And we can actually even look at, and as part of the improvement process, we can actually even look at, you know, how often they invoice. So is it at the start, is it at the end, is it on the 15th, or is it just, you know, as they go evenly? And if we adjust some of those, that will change the prediction on when the monies will actually come in. So if we say to them, well, look, if we can go through, on average it's taking you, you know, 52 days to get paid. If we can actually turn that and help you with some changing of trading terms, actually a few ideas on actually how to get that money in. Let's just say we can get the average debtor days down to 40. we go. And we have a look at, say, gadgets as well, same sort of thing. And convert that, 40 days. And parts and equipment might be another one. Let's just say we can get that down to 22 because with the parts, the smaller items, we might suggest that they actually insist on cash for certain levels up to a certain amount. And then if we have a look at their stock, and if their stock is in fact taking on average, and we've done the numbers, 75 days to get paid, and let's just say, well, look, with a bit of help, you might be able to improve this and get them down to 50. And again with the gadgets, 53, let's try and get those down to 40. 33, I should say. And then let's have a look at how quickly you're paying your suppliers. Now, you know, obviously if you've got 30-day terms and you want to keep suppliers coming in, I mean, this is purely an example. You know, sometimes we'll see clients actually, very rarely, but paying more than they should, but it might well be that we can negotiate some, you know, an extra, some trading terms that will in fact allow us to improve the day's credit, which purely just delays the timing of our payment by another 5 days. So I'll put that in as well. Do it for a couple of the main ones. We'll make that 35. Do that. And then let's have a look at what that's done to the cash flow. There was another one that I hadn't put in, which I need to, which is the parts. Okay. Change that. Basically what you'll see is over on the right hand side that our bank account balance has actually almost doubled to 91,000, and if we look at our cash flow, it will actually show that we started off with 50,000 at the start of the year and we ended up with 41,000 positive cash movement, so that we ended up with 91,000 in the bank. Now, we haven't actually obviously got the 153 in there because there's been other things that have come out, such as, you know, bank loan repayments, you know, payments drawn by shareholders, etc. But what we've done is we've actually found a way, based on existing profit that we've budgeted for, how we can actually improve our bank balance. Okay, so you know, in order to actually get that to work, you need to go through this particular process. So it's a very powerful way of working out, you know, how much do we want to make realistically, or do we think we want to make? If we are going to make that sort of money, what does it convert cash flow wise? And if so, is that enough? And you'll see that this is actually called a three-way budget. So this is the profit and loss budget that we sit down and work out with clients where they think, what they think they can do. That also produces a budget for the balance sheet, which is the second part of a three-way budget, and finally it's the cash flow budget, which shows how much money actually ends up into the bank account. So that's very important. It's a very powerful tool, and pretty much when you go through that process, it really does give the client understanding on what profits they want to do, whether or not they've got enough money to go that will find their way into the bank to meet their commitments, and also what their balance sheet will actually look like. It's very, very powerful. Okay. So if we just go back to our presentation and I look at why it's important to look at both, and that is a profit and loss budget versus a cash flow. Well, we want to make sure that we're able to make a profit for a start, because if we aren't making a profit, then unless we know there's going to be a loss for certain reasons, whether we know there's a bad year coming up, which may be out of our control, but we're going to try and limit the damage and see what money we'll need to tip in, or unless we're a startup where we realise that there is going to be a loss until we get the business going, then unless we're in that situation, if we aren't making a profit, we can be sure that without any capital injections, pretty much of funds, we're going to run out of money. So once we've established that the business has the ability to generate a surplus, we need to ensure that it is enough to cover non-profit and loss items such as bank loan repayments, etc., dividends, drawings, and if it can't, we need to see if we can generate enough surplus to cover these repayments. Then once we've done that, we need to ensure that those surpluses can be converted to cash very, very quickly. We need to allow for growth, and the reason why I say that is that if we are going to increase our revenues, typically there will be some things in the budgeting process, of course, such as wages and maybe other costs, marketing, etc., then that will need to be factored into the three-way budgeting process. But very, 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 very simple to do and very, very powerful. All right, so let's get this to. So we might have an issue with the technology, but we'll sort that out. Okay, here we go. Okay, so let's have a look at the differing budget processes. And a good place to start with any budget process is looking at the previous years, particularly the most recent 12 months, or in the current year that we're in. You can do what's called a sensitivity analysis by just say adding 10% to revenue and expenses, and typically that's what a lot of people do. You need those to look at the balance sheet and determine what happened to the profit and loss, and understand, if you're going to add 10%, where the final result is sitting in terms of cash flow. You would need to actually calculate debtor days and cash lockup, and there's a simple formula for that which we've listed. It's usually the average debtors divided, excluding GST, divided by sales for the year, excluding GST, multiplied by 365, and then just check that it all makes sense. Alternatively, you can actually use the budgeting process, to make real change. So what we would recommend is that you actually start with an end figure in mind about how much profit you would like to make, and then how much cash you would like to have, so in the bank. So you'll do that. You'll work, and it might be that you need to make a certain profit, one, not only to generate enough cash to make sure the business is generating enough for you to live, but also it might be that you're trying to get to an anticipated improved valuation, because the more profit and the more cash that your business can make, the more valuable your business will be. So that's okay. So work backwards, look at the increased revenue that you need to look at, and that could be, you know, can we increase our price? How many new customers will we need? What is our existing retention rate of our customers? Have we done an analysis of all those? Can we reduce overheads? You know, review some of our supplier relationships. Can a better deal be sourced? Have we spoken to them? You know, are there things that, you know, perhaps bulk deals that could be looked at as well? Should we be looking at a buying group, joining a buying group? Number of different ways that we can fix that. Again, remember that if you're going to increase your revenue, that sometimes overheads will have to rise, such as marketing and new employees, etc. And then we need to recalculate our debtor supply terms and do what-ifs on these. So, you know, if we know we're on average we're only getting paid every 52 days, then we need to work out, well, look, you know, can we fix this and improve the cash flow by changing those key drivers and formulas, and what will the cash balance look like at the end? So once you've done all this, well, I think this is where, you know, you're starting to have what's called a business by design, not a business by default. And I've talked about these in previous webinars. And so it's really having a bit of a forward plan. And we're starting with the end in mind, and then we're working backwards. And we're actually now going to say, well, that's all well and good. And I can understand for people on the call today probably saying, well, that's great. You've just gone in and changed a few drivers, and, you know, and that's very simple on a computer screen, and you've actually gone in and changed revenues, and you've moved them up and whatnot because you've decided that, you know, you're going to actually help us get to a figure, which is great, but is that practical? Well, this is where you need to have a strategic plan. So it's all very well, and it's very, very important that you understand that if you are, what are the numbers that you need to be doing? What are the cash flow drivers, and where are they at now? And then what are we going to do to actually make these happen? So this is where you'll have, you know, a detailed strategic plan saying, right, we've got our targets. Now we need to figure out how we're going to actually make these happen. And will we make? Is there a guarantee that you'll make them happen? Well, of course not. But if you have a plan and you're looking at how you can achieve these, then you've got a much better chance of getting there. But even if you don't, you would have been, you know, in all likely circumstances, never have even got close if you hadn't gone through this process. So again, you know, how many new clients do we need? What effect and what level of price increase can we look at? Where are they? So have we actually sat down and figure out where our clients are? You know, what type of demographic are they? How are we going to get in front of them with our marketing? What's our marketing going to cost to do that? What's the best form? What are the best forms of marketing? These are all things that we work with our clients and give them ideas. For any new leads, you know, how many of them do we typically convert? How can we improve those in terms of productivity? If our team are being measured on how productive they are, can we improve this percentage? You know, can we rearrange some of the things that they're doing that will actually make them more efficient? How many clients did we lose? So, you know, a bit of an idea on, you know, percentages on how many customers, clients did we win, lose, or keep. How can we improve that? What are the strategies to give us the best possible chance that we don't lose them? A number of different areas that we can help with and look at. And there are many other areas, of course, and this is just an example. So to just give you a bit of an idea on how we work with our clients, and here's just an example of an engineering firm. We'll run a planning session with them. We'll do a SWOT analysis. We will, with them, we'll facilitate that. We'll actually then go through and set up what we call a one-page plan, which looks something like this. And you'll see that we have targets for the 3 years. We don't even look just at the one. We do have the 1 year goal, which is very important. But we also look at quarterly goals, and we look at our targets for the next 3 years and how we're going to get there. So this one-page plan will, which we help our clients fill, and get in, and what are the key actions that need to be taken, the critical numbers, and then how we're going to actually achieve that. We'll work through that with our clients and go through the processes and get them each quarter to update this and see how they went, give them various actions. Here's another example of a one-page strategic plan. If you can see that. Again, SWOT analysis, targets. Obviously, it's not filled in. We're very strong on the Gazelles company that provides some of these tools. We've used them ourselves and found them to be very successful for us. In fact, in the last 12 months, we've grown our business by 25% in terms of revenue and profitability. So we strongly recommend these. All right. So, but again, looking at budgets and doing some strategic planning. Look at where your business is now, understand the drivers, where did the cash go, what can you do to improve it, do a budget for at least the 12 months, sometimes we do them for 3 years, work backwards to figure out what sort of cash you'd like to have in the bank and what profitability you'll need, and assumptions on how quickly you can collect the money and how you can actually improve cash flow, and then have a strategic plan. And get it done. And you go through this process, it is absolutely fantastic. So let's have a look now then at some of the other processes, or some of the other areas we haven't yet discussed today, I should say. And what is the bank's view of budgeting? Well, many of you, I think you would agree that banks would prefer to lend to businesses that do have budgets. They will often insist on budgets, but when they ask for those, are they looking for the profit and loss budget or the cash flow budget? Typically, they're asking a cash flow budget, but a lot of clients probably don't understand how to actually do the process and how to do it properly. By going through the three-way budgeting process and strategic planning, they can see that there is better planning for a better business. The shortfalls in cash flow that have been identified, if there are going to be, and even allowing while you're getting some of these processes in place to get them to work, well, at least you know well in advance and you can warn them. So you're not giving your banks or bank manager any surprises, which is something I don't like surprises. Risk of loan defaults is greatly reduced, and of course, if you're going for extra funding and you can see you need it, then you have a much better business case put forward than just along the lines of saying, well, we can see when it's going to happen. We're going to need some help at this stage, unless, hopefully we won't, but this is the way it's going at the moment. We can see it. So that gives you a much better chance of getting the funding. In terms of, they're going to be feeling more comfortable that the business owners understand the difference between profit and cash flow and what the key drivers are, and they're doing something about it. Hopefully that all makes sense. So what are some of the other benefits that are going through, the process, three-way budgeting, and improving your key performance indicators and drivers? Well, with the advent of cloud computing, such as MyOb Live, Xero, Sasu, example, once your budgets have been set and you've gone through the planning process, you can actually put these in and monitor them monthly. Yes, you can do that probably already, but your accountant can now much more simply dial in and have a look. And there's no need to be transferring files backwards and forwards and having a look, but it's certainly a much easier process of holding a monthly management meeting or quarterly management meeting, and it's never been an easier way to do it. Your advisor now has an easier, quicker and better way to offer a board meeting process, as if being a fellow board member, and that's how I'd certainly view it. If this was my company, how would I actually monitor my results? What is the cash flow? What is the profitability? What are we doing about it? What plans do we have in place? Are they being adhered to? Are actions being taken? Because we all know that leaders act, and if leaders act, that's a much better chance of actually getting things done and implemented, and as team members they will see that things are getting done. It will improve morale, no doubt about it. So from each of these meetings, results should be discussed and an action plan developed so we can get everybody back on track and can be revisited at the next meeting. It's also important, as I just touched on earlier, is the businesses with a better cash flow and can show that they have better cash flow, and prospective buyers should be looking at the different numbers to see how quickly money is getting collected, etc. Then they will typically be valued higher because there's a less risk. So in terms of setting key performance indicators, it's important to understand the KPIs and monitor them closely. So again, you need to look at things like your debtor days. If you have work in progress in stock, you need to look at that as well. You want to have a look at what are your gross profit margins. Can they, where are they at the moment? Doing some changes, can they be improved in terms of, either through price increase, better buying power, etc. Profitability, obviously that's a big one. Wages as a percentage of revenue, keep an eye on that. See if you can actually improve that, set yourself some goals. In terms of supplier days, how quickly are we paying our suppliers? Can we do something better there? Hourly rate per full-time equivalent, FTE means full-time equivalent. Then, can we actually do something there in terms of seeing where we're at the moment with that, and by changing efficiencies, can we up that rate? And again, once you've done that and you're monitoring and you're focusing on that, you have a much better chance of improving the bottom line. In terms of the average hourly rate recovered, if you're a service business, professional business, then you would typically look at the number of hours you've worked on jobs and what was the average hourly rate recovered. You'd set a goal at the start of the year and then go back to it. In terms of director productivity, you will perhaps want to know, how much time you're spending on the business as opposed to in it. If you're just working in the business, nearly 100% of the time, you can bet your life that very little's being done on working on the business. So if you change your productivity levels, what effect will that have? But then what you're expecting is that you will have enough time to actually improve the business performance itself. All right, so let's have a look at what we call a value improvement program. So basically, if you want to improve your cash flow and you want to improve your business value, then we would recommend that you look at having an understanding what your true value of your business might be worth. How does it compare to other businesses in your industry? If the business is going to be part of your retirement plans, how much does it need to be valued in order for you to retire comfortably? So we call that a value gap analysis. We can assist you with that as well. Is the profit being optimised? Again, going through the other process, the three-way budgets, that's what we look for. And, with strategic planning, we need to assist you there. Benchmarks, obviously look at benchmarks and see how the business prepares, and we use a company called IBISWorld that we subscribe to annually and receive a number of, or unlimited access to all the different benchmark reports, and it's a very powerful comparison tool. We then look at what your business might be worth, revalue that if you get to the level that we're hoping to over the next 3 years, and we quantify that improvement then based on what it would be worth then and how that would reduce the gap in order for you to reach your retirement. And all of these things basically revolve around growth of your business, improvement, and having a plan for succession. So if you are thinking of having some sort of succession plan, then what sort of numbers do you need in order to get to these sorts of areas? So for those that are attendees, and all of you, and thank you for your time today, we do have a special offer. This is something, this process I am absolutely passionate about. We can obviously assist you in some of these areas, but to get you started, for attendees, the first 10 businesses that contact us, they will receive a review of your current budgeting processes and recommendations for improvement. That's valued at $350. We'll give you an analysis on where your business's cash has gone for the past 3 financial years and giving you a bit of an understanding of how and where that's happened and why it's happened. That's valued at $550. We'll do an analysis of your business's key drivers and a recommendation of which ones you need to focus on, just purely by looking at your financial statements and having a bit of a discussion, and that's valued at $650. We'll give you an initial business valuation assessment, and we have a little tool that does that. Will also be a mini SWOT analysis: strengths, weaknesses, opportunities and threats. That's valued at $1,500. And for the first 10 that actually contact us, and for an investment of $280 only plus GST, you will receive all those things, and they're all valued at a total of $3,050. So for an investment of $280, which believe me is very cheap to understand the issues that we've just put up there in the points above, then I would certainly recommend that you consider hopping on and contacting us ASAP. Jackie does have, from my office, does have the forms ready to be emailed to you. I think there might even also be a link to our website, but Jackie will email you all, and the first 10 will receive that special deal. Okay, so in terms of, we're wrapping up now, but we would strongly recommend that you consider your position, how you currently, your cash flow and how your budgeting processes currently performed and how they look. We would recommend that you let us, consider meeting with you and help you understand and confirm your situation better, so that we can understand your needs, your objectives, and how we can help you secure your future. And that's about it, really. So I'd like to thank you for your time today, for attending the webinar, and I hope you got a lot out of it. And if you have any questions, please let us know. You can do that either via the website or please contact us via email or by phone, etc. But thank you, and we hope you have got a lot out of today's webinar, and we wish you the best for your business future. Thank you.